Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In this episode, member E. Choi shares his break from the traditional path not once, but twice already in his young career. We cover how he broke into the Blackstone restructuring group, which is one of the most prestigious groups on the street, coming out of Wharton, why he left only after 10 months to join a startup hedge fund, and what comes next with his own startup, atom.finance. All right, member E. Choi, thank you so much for joining the Wall Street Oasis podcast.
Thanks for having me.
Awesome. It'd be great if you could give the listeners just a kind of short summary of your background.
Sure. So I went to Penn as an undergrad. I was in a program called the Huntsman program, which is a coordinated dual degree program between the college and Wharton. At Wharton, I studied finance and accounting. And in the college, I was an international studies major and actually did a semester abroad in China, in Beijing. And then for my sophomore year internship, I worked at a small credit hedge fund. Okay. And then junior year, I worked in the restructuring group at Blackstone. So I was there for that summer. And then I got a return offer and went back after I graduated from Penn. So I was there actually for only 8 months. I left to join a newly launched hedge fund that was started by one of the partners from Union Park called Governor's Lane. And I joined right before we launched in early 2015. We had around $700 million under management at that point before we launched. So I was involved in kind of the initial portfolio building and kind of the stock selection for the launch. And then I was there for a bit over 3 years until early last year when I left to do something else. And I started a fintech startup called atom.finance, which is now what I run, and I've been doing day-to-day since then.
Awesome. Pretty interesting background. So let's go back all the way to kind of your time at Wharton, and specifically, when you went in there, were you like, for sure, you knew you wanted to go banking, and kind of what kind of pushed you in that direction? Was it more like, hey, didn't know what I wanted to do, and I kind of just followed the herd, or was it something where like you've known for a long time you wanted to do finance?
Yeah, so even in high school, I was always super interested in economics. It was like always a passion of mine, especially like when I was in high school, graduating in 2010. So financial crisis was like, sophomore, junior year. I remember like reading a lot about it and was super, curious. And I'd always been fascinated by, businesses and stocks. And actually my uncle had been in the industry for a long time. So that's partly why I think I was initially inspired to, learn more. And so as I got more curious about learning about stocks and businesses and economics, I thought that it could be interesting to go to an undergraduate business school or to do economics somewhere. So I think that's always an interesting decision to make if you're interested in kind of doing a career in finance. You obviously can just do go to a great liberal arts school, be a liberal arts major, and I don't think it in any way precludes and may, in fact, in some ways it may be better to do that, but I think it just really depends on what.
Are you saying that because are you saying that because I went to Williams College?
I actually forget. I didn't realize that.
No.
But part of the reason, frankly, for myself was I went to high school called Lawrence School, which is not small, but it's a boarding school, and frankly, the experience there is very NESCAC or liberal arts school-esque. So it's kind of like I don't want to do this for round two. So that's definitely what drove me to a bigger kind of research university.
Yeah.
But I think there's advantages and disadvantages of both doing liberal arts versus undergraduate business. I think it also depends on what kind of peers you want to surround yourself with. If you want your peers to have a particular industry focus, and definitely Penn, as I'm sure a lot of people know, has a super pre-professional vibe, and that's actually something that I liked. I liked the fact that it was very practical oriented. So I knew I probably wanted to go to an undergraduate business school, and I applied to the Huntsman program just because I thought it was a kind of interesting layer on top of, instead of just being
it's
a
the
Wharton
best
student.
School.
I thought it was a good opportunity.
It's the best school too. Come on, let's be honest. Especially
Wharton, well, yeah, they'll say that. No, it's definitely great. I mean, the
Well,
what's
I'm
interesting
biased.
actually about.
I got my MBA from Wharton, so of course I'm biased. But
All right, exactly. You're biased. But actually, what's interesting is that there's definitely been a shift in the school. I would say for sure over the last 10 years, from definitely post financial crisis, where I think less. If you look at like the career stats, a lot less people are going to banking consulting.
right.
Still like a large majority, but it's less.
Yeah.
And actually, there's quite a large scene now of people going into major tech companies and doing startups. And the school has actually kind of shifted and expanded its curriculum offerings from traditional finance accounting actually into like the stats department's very good, the marketing department's very good.
Yeah.
So there's a lot of other kind of data-driven curriculums that the school has kind of laid out, which are not just pure traditional, do finance and accounting and go into investment banking. Although Wharton's still very good at that, obviously.
For sure. No, it's funny you mentioned Lawrenceville. I went to Andover, and my mother just actually retired from being head of school at Deerfield. So small world.
That's funny. I did not get into Deerfield, but I definitely visited.
I wouldn't have if I had applied. So, anyways, so okay, great. So small world. But anyways, so you get to Penn. You're studying. You go to China for a year. It sounds like.
It was a half year, actually.
A half year, so a semester. Yeah, and so tell me a little bit about that. That's interesting. And what if anything did that do for you in terms of like perspective? I mean, would you recommend it to other people?
Yeah, I think studying abroad is like super fascinating. I think there's a couple of ways to do it. One is to just do a summer program somewhere for a few weeks. I think that's interesting, but it's definitely not the same as taking a full semester and actually living somewhere. You just get a lot different of an experience.
Right.
If you are proficient in the language, I think it's very fascinating to actually go somewhere for a full semester and then just enroll like a local student, which is kind of what I did.
Right.
So I was just in classes with other kids at the university I was at. It's called Tsinghua in Beijing, but basically I was just another student there, and the classes were all in Chinese. So I'd be lying if I said it wasn't extremely difficult to like study economics in Chinese. So that was definitely challenging. But I think the more interesting part is just the cultural living experience, especially if it's a very different type of country. You learn a lot about the way like society is organized, like what people actually care about, the way like business is conducted. And I think, I'm not obviously, working at a major, conglomerate and with a large China business, and I'm not doing that. But I think certainly if like anyone has an interest in being an exec at a major Fortune 500 with potential to like work in a place like China, like it's pretty important to have spent like a good amount of time there, because otherwise I think it's just very hard to understand how to do business in some of these countries that are quite different from the U.S.
No, for sure. That's fair. I've heard of that from a lot of guests, both people who are born and raised there and the people who've kind of been transplants there. And it's tough if you don't have at least a ton of many years of experience there, let alone a semester abroad. Probably wouldn't be enough. But anyways, so
no, exactly.
So you're at Wharton, you're doing well, I assume, and then you start kind of gravitating towards the whole kind of banking recruiting cycle. It sounds like, because you were interested in anyways, and obviously there's a ton of students at Wharton that are kind of gunning for those. Can you tell me a little bit about how competitive it was, what that culture was like, and was there any stress around that, and specifically did people help each other, and what was that whole kind of recruiting process like on campus?
Yes, it's pretty interesting. So I had a pretty good cohort of friends who were all like, very interested in working in finance jobs, whether that was at funds or in banking. And actually people, I think Wharton has this negative reputation about that it's like super cutthroat. And I remember the one analogy someone had once told me was like, people will like rip out pages in the books, so other people can't study or whatever made up nonsense there is. It's definitely absolutely not true. I mean, the reality is that all of the classes in the core curriculum are graded on a very strict curve. And I actually think that's great, because I think, frankly, it teaches you that, no matter how smart you think you are, it's irrelevant, because a lot of the core classes, though, like, it's not like, you're not studying linear algebra, it's, accounting 101.
Right.
Because of the fact that there's a core and there's a lot of smart kids, you really have to grind hard and, like, really study. And if you do not study, you will absolutely not do well. So I think that lesson in and of itself, and, we can talk about the lessons I think that banking teaches, that's definitely one of them, I think is just a valuable life skill to understand that, like, you can't just rest on the fact that you think you're super smart, because there's a bunch of other super smart people who may work harder than you, and then you're not going to be in a good place. Right. But in that context, I think I had a very supportive group of friends, and people were definitely open to help each other out, and doing mock interviews. There's definitely a big culture at Wharton of doing mock interviews with seniors who have already gone through recruiting, and they're willing to help you and kind of walk you through what you should expect in that process.
That's great.
But yeah, it's definitely, look, the reality is like it's obviously definitely stressful. It happens quite quickly. I have no idea at this point when that recruiting. Last I heard it used to be in the spring, or it used to be like right after I guess you got back second semester. So this is maybe not spring. So this is like maybe Jan or Feb. But now I heard it's actually in the fall. Apparently, I don't even know anymore. So it's like it keeps moving up, which is pretty crazy to me.
Oh yeah, every year it's like earlier and earlier. It's like private equity recruiting too. It keeps coming up like up 1 or 2 months every single year, to the point where now people, when they get their banking job, and within like probably this year, it'll be in the next couple of months. They're for a job 2 years out almost, for a job 2 years out.
Yeah. No, it's pretty crazy, and obviously, like the actual recruiting process is quite short. I think.
Yeah, can you tell me about like how many resume drops you did, and then how many interviews you got, offers, stuff like that? Can you give me some stats around that?
Yeah, I'll try to remember. So I definitely dropped the resume like literally everywhere, because it's like, why not? It's a free call option. So I don't know, I'll make up a number, but it's probably like 40 or 50 is my guess.
Yep.
I assume that if I were at Wharton now, the number would likely be higher, because there's probably even more jobs with a lot of buy-side firms recruiting.
Yep.
So I did that. I probably had like, I want to say probably like 10 or 12, maybe 14 on-campus first round, something in that.
So around a 20-30%, 20 to 30% conversion on those drops. Not bad.
Yeah, something like that. That's like, I had a pretty good resume, just for the fact that like my GPA was good.
Like 3.8
and I was
or 4 or
I did 3.8, like 3.85 or something like that at the time.
Yep.
That was before my China grades came in, which weren't great. But
well, you were taking classes in Mandarin, so that's fair. But keep going.
No, exactly. I was a finance and accounting major, and I had done concentrator, I should say, and I had done a few finance-related internships. I actually worked. One of my closest friends' dad worked at this long-only fund, which is pretty well known, called Pazina. So I actually had an intern there senior year of high school. So that was like the lucky, just obviously family connection, which helped. But so I had like a decent background in the space, like had some earlier internships, and I had a clear, people just talked to me, like I had a clear-cut passion for finance. And I think the one interesting thing is, if you actually are interested in the industry, and you actually care about investing, you can definitely differentiate yourself. And the reason is that there's a lot of people who are just obviously at Wharton and just trying to do it just because they think it's an attractive, from a financial perspective, an attractive career opportunity. Mm-hmm. If you actually do enjoy it, like you should make that very clear in interviews, and it just kind of comes out naturally. And that's definitely like a large, competitive edge.
So you had So you had that hedge fund internship senior high school, but then what did you do for freshman summer and sophomore summer?
So senior year I worked at Casino, which was basically like a mutual fund, a long-only investment manager. And then, the hedge fund was sophomore year. Freshman year, I actually didn't do an internship, if I remember correctly.
Okay.
I think I did a summer. Oh, actually, I took classes at Penn. That's what it was.
Okay.
I took a few extra classes just to kind of, because I had a very tight schedule, so just to kind of relieve that.
Nice. Okay, so you kind of had that internship sophomore year, so that was a good internship to have on the resume going into summer analyst recruiting.
I think, and my guess is it's only gotten worse, so I think it's probably very helpful to have some sort of relevant internship experience, if possible, sophomore year. It does not have to be like at a fancy firm. It doesn't have to be a big fund. It could be
anything related to finance. That's what I tell people, like anything at all related to finance. Like if you can get into a bank, even if it's a tiny regional bank, that's fine. Just try to get in somewhere.
Yeah, exactly. I think people are still too focused on like the prestige of the place or whatever. And like I worked at some funds, like there's a bazillion funds, like no one cares. No one knows any of these places. But what's important is that it shows that, you're kind of dedicated to the craft, and that you actually, care, and you put in the time. So
and so
I
summer
definitely
analyst
would recommend that.
summer analyst recruiting, did they give you any flack for it being a hedge fund and not a bank, or for working at a fund in the buy
No,
side? No.
so I think we could talk about that later. After my junior year internship, there was people question whether I wanted to work at a fund, and that was actually correct.
Yeah, as a recruiter, I'd be like, he's a flight risk. He's a flight risk.
Correct, which was true. No, I don't think anyone, like, not at that, definitely not for junior recruiting. No one cares.
Okay.
Really, I think it's just important to show interest.
Okay. Cool.
So yeah, so the way it worked is, at Penn at least, you have first round interviews on campus. Those are like pretty short, if I remember correctly. I want to say like half hour. They like slot in people back to back all day, and you do that. You
mostly
run around
fit, mostly technicals, or kind of a combo.
Yeah, it's a mix. It's like usually something like 10 minutes of fit and maybe 15 minutes of basic technicals. And again, I'm maybe a little stale on this, but it used to be like walk me through an income statement, or if I add $10 of depreciation to
the basics
income statement,
basics.
how does that? Yeah, exactly, stuff like that.
Yep.
If there were some of the better, I'd say the higher quality boutique investment banks, they're usually the questions are a little more thoughtful, and it might be something like if two businesses have one business has no leverage and one business has a moderate amount of leverage, like which one should trade at a higher EBITDA multiple, or things like that, which actually require you to understand like the value of interest tax shields or whatever, like a little theoretical understanding.
Right.
I'm not sure, to be honest, if at liberal arts schools, if they're a little less technical. My guess is they are. But at Wharton, especially, the expectation is that, especially if you've taken those classes, that to answer those questions. Otherwise, that's a real problem.
Yeah.
So if you have taken relevant coursework, you should definitely,
be ready
just
for that.
brushing up and knowing the answer to those sorts of questions.
Yeah, back when I was at Williams, almost 20 years ago, recruiting, not 20, but close now. There was like no technicals, or very few, until like the final round. But even in the final round, they would kind of test to see what you knew. And for me, it was very little at the time, because it just wasn't needed. You could kind of just be like, oh, I don't know. I have no idea.
Definitely if you're at an undergraduate business school, like you should
you're expected
be getting those sorts of questions.
Yep.
Yeah, exactly.
All right, continue. Sorry, I interrupted you.
No, and so so it's those are pretty short, and I think you basically run around doing that for maybe call it a week and a half, and then generally the banks will have super days, which were meeting kind of 3 to 5 people, maybe 6.
Were those on campus back in 2013, I think it was, or 14? Was it on campus, or was it actually in the office? Did you have to go to New York?
Yeah, so it was in the offices. I don't know if they've since changed that. Yeah, so it was. I remember I had super days at. I think it was Morgan Stanley and obviously Blackstone and maybe one other place. Maybe it was Evercore. And then I had one hedge fund. But yeah, those were all at the firm's offices. So you have to go to New York. And then different firms are, I guess, different about how they do that. But they were definitely a mix of, again, very similar, like mix of fit and technicals. And some people were nicer than others, and some people were very mean and just asked you crazy technical questions.
Good cop, bad cop. Good cop, bad cop.
Yeah, exactly.
Yeah,
or just bad cop, bad cop. But,
two people just attacking you, be like, "You think you're so smart, kid? Let me ask you these 20 technical questions in a row." Anyways.
No, exactly. I mean, one thing that definitely helps that I would recommend people is to try to actually talk to people who are first or second year analysts in those groups. I had the luxury of knowing a bunch of people in the restructuring group at Blackstone, just because there were a lot of former I should say Wharton alums there, so I who were 1 or 2 years older than me, so I knew them, and I could talk about the group is so great, and this is why, or this is what I find interesting about the industry or the job. So it's good to do that if you have the ability to do so, because then it makes it more, it shows intent more, and that you're not just trying to like shop for offers, and that you view all of the investment banks as a commodity, which may or may not be true, but you obviously don't want to express that when you're interviewing for a job.
It's basically, you're saying it's easier to convince the recruiters that you're serious about Blackstone restructuring when you say, I've spoken to A, B, and C, within the group,
Exactly.
and you're really exciting because of these deals you've done, and da da da. And I find that type of work interesting. So, okay, was it true, or was that the only offer you ended up getting? Did you get Morgan Stanley, Evercore? What was the kind of final tally?
So I got
hedge fund?
if I remember correctly, I got the Blackstone offer, I think, before the other ones.
Mm-hmm.
And I knew I was going to take that.
Okay.
So I just ended up taking that, I think, before I just told the other firms.
Got it. Okay.
So I mean, I knew basically there was a hedge fund I was interviewing at, which I was considering, which actually a very close friend of mine ended up working at, which does distressed debt that I was thinking of working at. But I just felt that my view at the time was that whether or not I wanted to do hedge fund recruiting, and this in 2013, it was still very early. Like, there wasn't a lot of buy-side firms that recruited that at Wharton. There were a few big hedge funds, and then PE had started to recruit more. I think so. Silver Lake had recruited, Ares, Blackstone, maybe KKR and TPG, but like small, like maybe 2 seats, like very small quantity.
Do you think those were the most competitive seats to get into?
Say again?
Do you think those were the most competitive to get into, specifically at Wharton, where people jump in? Yeah, I'd assumed trying to skip banking. A lot of people trying to skip banking, right, and just go straight into PE, and it get pretty.
At the time, it wasn't done like as much as I think, as much as it is now. But it was definitely, I would say those were definitely viewed as some of the most prestigious jobs. I think in banking, Blackstone restructuring was viewed as probably the most prestigious job, and that there was I think people had gotten offers from both Blackstone PE and restructuring, and chosen different routes and hedge funds. So it was all, they're all good. I think my frame of reference was essentially that regardless of what I wanted to do for full-time recruiting, it would give me maybe slightly more optionality if I did a banking internship junior year, because then it's always hard to basically intern at a hedge fund and then
go banking.
Let's say you do get a return, exactly, or if you don't get a return, then you're not in a good spot, because then they're like, well, why did you work at a hedge fund? Why didn't you just going to leave early or whatever?
Right.
So that's always a delicate. So if you do go intern at a hedge fund or a PE firm, you should definitely get a return offer, ideally, and know that you likely want to do that, because otherwise it's a little bit, you can do it, but it's just a little bit tougher to thread the needle on it and to explain that.
So tell me about, like, specifically the restructuring group at Blackstone. Was it specifically something where you knew going into recruiting that was the group you were recruiting for, or how did that work out in terms of the groups? Yeah,
I that was really that and PE were really the two groups that I was interested in, and Blackstone restructuring really was the main one.
But is that something you said, like, going up front, or something where, like, it was a different whole recruiting channel?
No, the first rounds were, I think, not. That's a good question. I think actually yes, they were all the groups interviewed, even first rounds, I think, separately. So if you wanted to interview for PE and restructuring, you had 2 first rounds and then 2 super days.
Got it.
And they kind of ran it as totally separate processes.
Okay.
If I remember correctly. So no, I always it's interesting. I had read like a book on, like, distress. There's this famous book by Stephen Moyer called Distressed Debt Analysis.
Yep.
And I'd read that when
Yeah. No, I've heard of it. I was in the restructuring group at Rothschild. I don't know if you knew, for 2 years.
Oh, okay.
Yeah.
Yeah. No, I know the group.
Yeah, go ahead.
No, so I'd read the book. I was like, oh, this is really, like, I had always kind of been fascinated by law, and I knew I didn't want to really become a lawyer.
Right.
But, the interesting thing about restructuring and investing in distressed debt is it kind of combines, business analysis and, legal work. Mm-hmm. And, it's both sides of pie and distribution of pie. So it's actually an interesting kind of thing to study, and it's kind of cool to be able to, for some extent of time, to go through contracts and be able to kind of think from a legal perspective and all that stuff. So that was just a kind of a more interesting banking experience than a traditional investment banking group.
Yep.
And I thought it would be just kind of more intellectually stimulating, which was true to an extent. But that was so that was kind of why I thought that would be the ideal group from my perspective.
So you get there, you land an offer. It's kind of the most prestigious group, or one of the most prestigious groups on Wall Street. It's incredibly tough to get into. you get there and then, you're out within 10 months, right? So what happened? Tell me about, like, were you working on some live deals? What was the thought process? I'd love to hear about specifically, was it something where you were proactively looking to get out after, say, 6-7 months, or was it something that kind of just serendipitously fell into your lap with the governor's lane position?
Yeah, so I did the internship. It was good. It was, internships are always short and it's always a honeymoon.
Yeah.
So got luckily enough to get the return offer, and I knew that I just wasn't going to like recruit at. I felt that my view was basically that working there full time and doing like the proper full hedge fund recruiting process, 8 months in or whatever it was at the time, would give me more kind of fund options and potentially better funds and also new startup funds. And that was not an option direct from undergrad, whereas there were only a few major hedge funds that recruited. And so I basically felt that, hey, look, if you're going to go right out undergrad and work on one of these big funds, like you kind of have to stay there for at least 3, 4, 5 years before you transition to somewhere else.
Mm-hmm.
Versus like doing, at the time the presumption was 2 years at Blackstone, and then I would have, during that recruiting process, a lot more optionality. That's why I did it. I was on there's a few live deals. I had one like debtor side bankruptcy deal with a shipping company that I worked on, which was pretty interesting.
Mm-hmm.
Shipping, for those who don't know, is by far the worst industry of all time. Never invest in anything related to shipping. Everyone's been betting on the recovery of the shipping of dry bulk or whatever for the last 10 years since the financial crisis, and these companies just go bankrupt every 2 years again.
Oh my God. Well, it's like airlines and it's like paper and packaging was a structure I worked on.
True.
But airlines seem to have been doing better, have had a nice long run now, but we'll see.
Exactly.
Anyways.
Yeah, but well, that's the one. In all seriousness, the one I think a huge ding on working in a restructuring group, I think, is that obviously it's not a surprise that you tend to see very low quality businesses in very cyclical industries. Mm-hmm. And so the sad thing is that you don't get to really appreciate, I think, business quality and understand like how to think about the real quality and long-term earnings power of a business, which I think if you want to become an investor is like much more important to understand than like all this complicated valuation stuff. Because in the end of the day, like I think the greatest investors really have a firm understanding of like, long-term earnings power of businesses and business quality. And that's definitely not something that you're going to pick up in a restructuring group. However, there's other advantages, and it's not clear to me that obviously you're picking that up in some banking group at a bulge bracket. So, there's a debate to be had there. But in any case, I was on an interesting debtor side deal. I learned a good amount. I think, banking is banking, and, it involves a lot of client service work, which is just inevitable, the same in consulting. And so that was never something that appealed to me. I don't have an interest in like closing deals or servicing clients in that way. And so I always used to get frustrated when we had to like change a deck for, to please the company, or, to do a deck for, something that I thought was just kind of a waste of time, just
at 2 in the morning or 3 in the morning, getting called back into the office to turn the deck.
Yeah, exactly.
Yeah.
I mean, luckily, I think when I was there, our hours were pretty good because actually this was before oil went down a lot, so there wasn't all these oil and gas bankruptcy deals, so it was actually pretty quiet. But I think the issue is that
your hours were like 80 or 70 hours a week, or what would you say?
Yeah, it was probably like 65 to 70, frankly. So that's actually really good.
Yeah, that's pretty good for banking.
Yeah, I was lucky. It definitely picked up after I left. But no, I think what the issue is ultimately like, and this is a totally separate conversation, but to some extent, I think a lot of the banking industry, like other industries, are trying to justify their retention fees, and so the result of that ends up being that they feel the need to produce output, and then that output tends to come in the form of conference calls and slide production. And slide production is not necessarily linked to quality of job well done. And so it's just a classic like example of like, just different incentives. And obviously
you need to produce work product because you're collecting some sort of retainer every month in these terms of restructuring deals. So you can't just like, if you're collecting a couple $100,000 every month, you can't just sit there and like not produce something.
No, exactly. Yeah. And so that obviously that work filters down. And so ultimately it's some analyst who's like banging out, slides at 2 a.m. for some deck that is generally pretty useless. And that's just, but that's just the like nature. That is what it is.
What type of stuff would you
kind of
be
the
doing though?
structure.
Like what type of analyses? Like you're doing like different
So yeah, a
debt
lot of
capacity scenarios, projections, upside
Exactly.
downside cases.
Yeah,
Looking
so
at
like traditional like projections on like for the shipping company was okay. Let's assume that dry bulk rates go up like this. What does that mean for the earnings power of the business? What does that mean for
right,
the different tranches of debt? What does that mean for recoveries? And then
right,
based on these different scenarios, like how do we decide to equitize certain pieces of the capital structure, or carve up the pro forma ownership of the business, or whatever. And then there's all these other kind of corporate and for those who haven't worked in restructuring, it's not as relevant, but basically like a company is not just a company, it's a bunch of legal entities. So obviously there's implications for when debt sits at different legal entities. So a lot of work around waterfalls and related.
I'm curious. I'm curious about your time there. Were you, as an analyst, brought into any like meetings, actual negotiations with say the bondholders that you were negotiating against? So on the debtor side.
Yeah, it was.
Yep.
Yeah, it was actually. And actually, I would say, yeah, the restructuring group is Blackstone. I think the best thing about it was that there was a lot of exposure given to first year analysts, and like actually like a lot of responsibility. So for example, the projections I did and the waterfall analyses were actually, and this is true for any restructuring advisor on the debtor side, they were in the disclosure statement, which is like the official document that the bankruptcy court uses to give to all interested parties to kind of evaluate the case. So that's pretty cool. And obviously, like, you don't want to have errors in your model when that's showing up in a court document forever. So that's pretty interesting, and I was definitely like allowed to be in a lot of from the actual negotiations and those sorts of meetings. So that was definitely a nice part about the job.
So what was the impetus to jump, and how did that happen? How did that even come about?
So the typical hedge fund / PE buy side recruiting process kicked off. I think it was 7 or 8 months into the job, and I always knew I wanted to work at a fund, and so I was just kind of looking at what the different opportunities were in the hedge fund space. And I think one of the views I had at the time, which I think is now kind of slightly more obvious, was that and it's a whole, again, other conversation, but the hedge fund industry in many respects like has not performed, has not justified its fees. Like, it's pretty obvious. And so I think a lot of very, very large funds, especially excluding the multi-managers, just were kind of unsustainable in the sense that they were running $10 billion, charging 2 and 20, and then producing like pretty subpar returns. Mm-hmm. So I felt that at the time, like, it didn't really make sense to, other than for some very famous and select large funds, like I didn't really want to work at a large fund, because I felt that actually, frankly, the career risk reward of doing that didn't really make any sense. And actually, people felt that this is like a fancy brand, it's been around for a while, but actually, like, because their returns weren't great and the fees they charged were high, I was like, this is just just like you would look at any other business. I was like, this is an unsustainable business. And
it's
so
like a ticking time bomb.
I actually, yeah, exactly. And then the other component is that, just like any big bank or whatever, if you're the larger the fund, generally, like, you're more junior and you have less actually discretion for what companies you get to research, and for what and for how you basically allocate your time, and you end up being more of a, I don't use the phrase model monkey, but that's kind of true.
Yeah.
So I wanted to kind of go to a smaller fund that I thought I had a lot of personal kind of career upside, and that I was that I felt I fit well with the team and kind of the mission.
So your entrepreneurial chops were kind of showing themselves early on.
I guess to some extent. I mean, I would be lying if I say I wasn't. I was very like risk on.
Yeah.
And I basically felt that ultimately, like, I thought I was, I knew how to, or I would be a good investor over time. And so I was like, okay, well, if I have that view and I believe in, I have conviction in my own ability, then whatever, like, I'm going to take.
You
I'm
should.
very young.
No, I mean, you
family.
should. You're young. Yeah, it's the perfect time to do it. You're young. You have nothing tying you down. You lose your job, it's not the end of the world. Like, who cares? You might as well swing for the fences when you're young. So I love it. I think it was the right decision. So I don't know why so many people get so enamored with the big names, and then they maybe pass up on an opportunity that has so much more upside.
Yeah,
anyways,
I think people really struggle to divorce brand prestige from personal career risk reward. And I think, yeah, they get enamored with the brand, and it's like, okay, great, it's a good brand, but like you're not gonna, you can't like eat that at the end of the day. So it only does so much for you. And I definitely think it's important to focus on, just kind of where, like, what your personal like outcomes look like in different scenarios, and like it does that, like, which place makes makes sense, and also like where do you just like the people, like quite simply, like do you like the team, do you believe in the mission? Because ultimately you have to show up every day at work, and so if you don't, the second you stop believing in the mission and you don't like the team anymore, it's going to be really hard to be successful.
Yeah, no, for sure. And I think just to comment on brand, you were in kind of a little bit of different situation than a lot of the listeners here. You went to Wharton and Blackstone, so you kind of had the brand and the stamp of prestige already on your resume.
Yeah.
So you had a little bit of Go
I
ahead.
was just going to say that's a very fair point. I was in a position to do that. So what I would say is, for people who aren't in that position, it's the whole purpose of brand, in my opinion, is it's just a career hedge, right? It's just a stamp, and it allows you to, if you go do something and you're not successful and you get fired or whatever it is, you can always point to that. And I think it's the same reason that a lot of people who a lot of people get an MBA for a lot of the same reasons. And I think that's not, I think that's actually, a potentially a good decision, especially if it allows you to take more career risk later. But I don't think that it's a smart idea. And I've seen a lot of people from very, very good schools do this, do 2 years at this place, and then 2 years at this fancy PE fund, and then 2 years at MBA, and then 2 years at this other fancy, and like they're basically hopping around 2 years everywhere, collecting fancy brand names, but never actually building a real career or doing something real and staying at a place for an extended period of time. I think that's a huge, huge mistake. But I think a lot of people do it because they just get enamored with, it's like shopping at the mall and buying a Coach bag and then Hermes bag. And it's like at some point, like, you don't need all of them, just get one, and it's fine.
Yep. Yeah. It's diminishing marginal returns with each additional brand. It's like
Exactly.
It's like resume builders, right? They're like, what would make the best actual like branded resume?
Yeah,
and
right.
at a certain point, it's really diminishing returns. Yeah.
Yeah, exactly. Look, it makes sense. Like, if the first place you work at is not a super known place, and you have the opportunity to work somewhere that's a bit more known for a bit, like, that can make sense if it allows you to be, I think, a little more aggressive with your career as a next step. That's a great potential decision. But yeah, I wouldn't just run around collecting brands.
Great. Okay, so you're at Governor's Lane, and you're kind of it's a new fund. You said about 700 AUM, and you're kind of tasked. It sounds like you had some pretty big responsibility as a new analyst. You were helping kind of with the initial kind of portfolio construction.
Yeah, it was really awesome because it was it was like a startup. We were like,
how many people? How many people did it bring in?
So when I joined, we were like 4 investment professionals, including the founder, and we had like a CFO and a GC, and then we added ultimately a few more, two more investment professionals pretty quickly after we launched, and then we added a few more over time. Yep. It was a very very small team, super lean, small office, and it was exciting because we were starting a new fund, and the reality is, especially in hedge fund land, is that no matter how long your LPs say that their time horizon is, the first 6 months and 1 year and 2 years of returns are super, super important.
Right.
And if you have a bad first 6 months or first year, first 2 years, it makes it really, really hard to be successful. And it kind of puts the fund in a tough spot.
Yeah.
Especially for those who don't know this, the way fund economics work is that there used to be a 2% management fee, more like probably 1 and change now, but the 20% carry or whatever it is, if you're down over a time interval and you're below your high water mark, you don't get any performance fee. So what ends up happening is that people get paid less, so they're less happy, and then also the result of that is it does incentivize in certain situations people to be very risk on to kind of get back to the high water mark. So it's just not a place that you want especially a new fund, to be in. So you really have to really try to produce good returns for the first.
Yeah, for the listeners who are not as aware, so basically what's happening is the clock's ticking once you have that LP commitment, and You basically have to return over a certain threshold, a certain return, right? And then if you're, let's say you have a bad couple 6 months, it just puts you way behind. And so
we didn't actually have a, yeah, that's like a hurdle. We actually didn't have that.
Okay,
it was
great.
just kind of absolute, but some funds, that's more typical now. And yeah, so that's even worse. If you have like a,
it's ticking,
7% annual hurdle, then
Yep.
that's not, if you have a 7% annual hurdle and then your first year you're down 10%, you could do the math. Like you have to have a very good year the next year to get back there. So
just to even get to a chance to have any carry.
Exactly.
Yeah.
So in any case, it does create a lot of pressure, and like kind of it's not the right sort of pressure, because you should really be thinking about investments over a several year time horizon, and honestly ideally like you're a permanent owner of the business. But
right.
in
so
any case,
was this long short?
Can
you tell me about the type of investments you guys were making? Was it distress? Was it credit, equities?
Yeah, so we were an event-driven fund. Mostly at the time we were doing just kind of long short, not actually as much individual single name shorting, mostly kind of index hedging, and then just kind of traditional just longs that were usually like position size of anywhere from like 3% of the portfolio to like 7%. Was pretty typical.
Okay.
So not like reasonably concentrated, but not super concentrated. And yeah, we didn't do much. There wasn't much credit going on at the time. There wasn't really any distressed credit at the point. So, so we luckily had a good, a few 2015, not 2015 actually, but 2016, 2017 we did quite well. 2015 was actually a tough year, if I remember correctly, for hedge funds. But luckily we had a good, very, very good 16 and a pretty good 17. So that actually put the fund in a nice place, and the fund ended up growing to north of $2 billion at one, I believe.
Okay.
So that was good, obviously, and then the team grew and we got a bigger office, and so that was it was like
so
nice to
exciting.
see business grow.
It was exciting. So what do you think made you guys successful there? Was it just the actual research process? Was it all the fundamental kind of it sounds like your hold periods were longer than. You guys weren't doing any, high frequency stuff. It was just all mostly just actual fundamental research.
Yeah, no, it's just a traditional kind of fundamentally oriented.
Event driven.
Hedge fund, and
yeah,
so I think we had a few good investments, and they were sized properly, and that kind of, that worked. And I wouldn't say it's, again, I wouldn't judge any fund over like a 2-year time horizon.
Yeah, of course.
I don't think that means anything. It's easily explainable by luck or skill or both or neither.
Yeah.
But yeah, it was a good outcome. And then I think the thing that ultimately kind of made me kind of want to do something else, kind of probably starting in the back half of 17 was I always just liked investing, and one of the things that happens is as any fund grows, this is true if you look at returns across different hedge fund sizes. It's much harder to deliver good returns when you're a $10 billion fund versus when you're a $1 billion fund, because you can just do the math. If you are running a $10 billion fund and your average position size is 10%, you need to put $1 billion in a given position. There's not many companies that you can actually buy $1 billion worth of stock and not own like an insane amount of the company. So then you're just looking at 25 or 30 B plus market caps.
Right.
Which basically means that your universe of securities you can buy is just very limited, and so it becomes a little. And I'm not saying that actually it turns out that a lot of the best
and
returns.
the reason for that is you can't at a $10 billion fund you need to have a big enough. You need to write a big enough check on each one, and just given how big the team is, right? Otherwise, it's just too much work in terms of looking at like mid caps or small caps.
Well, also, I think, and it's similar in PE. It's no different than at a mega fund. Like,
right.
You don't want to, like, if your pitch is that we're a fund that, does deep fundamental research and we have,
right.
Differentiated views on business quality than the market. Like, if you you can't do that and pick 50 companies. Like, it's just impossible to be successful. Your hit rate it'll never work. So, the right way to do it is to have, 10 or 15 positions or whatever it is.
Yeah.
And do it that way. And so that means that then your just investable universe is that much smaller when you're a massive fund. So, but when you're running 500 million or a B, you have a lot more in terms of your ability to, look at a wider swath of companies, which I think is personally for me, a little more interesting. And it's no different in P if you're at a mega fund versus a a more
middle market fund.
Market fund.
Yeah, no, for sure. There's just a lot more out there if you're a smaller fund and you don't have to write as big a checks, put as much money to work.
Exactly.
So so tell me a little bit about the. So it sounds like it was very successful, grew quickly. It's kind of exciting for you. It surprised me you wouldn't kind of stay on and maybe get more carry and kind of grow with that firm. I guess maybe you felt like just you were itching to do something else. I'd love to just hear that thought process.
Yeah, my thought process was always like, I'd always liked investing, and it was always something I wanted to do, and so I always felt that, I should be enjoying kind of going to the office every day and kind of, doing my research and the work I was, supposed to do. And I think at some point, kind of after being here for a bit, the fund got a little more institutionalized as it grew, and I just, was enjoying the investing process less.
Yeah.
And so I felt that, given that I wasn't having as much fun, and given that it is a space that I like and care a lot about, that I should just kind of change it up. And so I didn't really know, frankly, what I wanted to do after, but I just felt that it made sense to kind of leave and I basically traveled for around 5 months.
Where'd you go?
Kind of just. I was lucky. I went to a lot of good places. I went to the Amazon. I was in like Morocco.
So cool.
Where else did I go? Yeah, I hopped around.
Did you take a boat down the river, down the Amazon?
We drove one way, and I was lucky enough to actually take a seaplane one way, which is for
cool.
anyone who ever goes to the Amazon. That's really, really cool. Actually, one of the largest freshwater archipelago in the world is actually in the Amazon. So it's really cool to. Anyway, but it's pretty sweet. I would recommend it if anyone ever gets down there.
Great. So you decided, hey, I'm going to hit pause. I need to just kind of figure out what I want to do next. You weren't enjoying the investing process as much. Makes sense. You had a smaller universe to look at. There's more institutionalized, larger fund. You said, maybe I just need to step back for a bit, take a breather. You'd been in banking and, hedge funds for a good 4 years at that point, or longer if you count your internship. And so totally makes sense. You hit pause, you say, okay, you do some traveling, and then what? Kind of what brings you to atom.finance? Or what kind of made you think?
So I actually so it's funny. It actually wasn't the initial conception idea. It wasn't mine. I actually reconnected with a very good friend of mine from Penn, who has been involved in several startups and kind of is actually pretty active as an angel investor. And the original idea
was he older? Was he older?
He's actually my year. He was in the Huntsman program with me as well, and we actually roomed together.
And he's an angel investor? He's already an angel investor? So he's done well for himself.
Yeah, he writes some small angel checks and kind of with some funds from his family has been pretty active as an angel, and then also actually helped. He went through Y Combinator and helped start a few companies as well. So he actually got the idea from what turned out to be our first investor, who was basically also very active early stage investor, and he basically had worked at Microsoft and had looked at Yahoo at the time, and was basically like, had the idea that Yahoo Finance was just it's obvious, this is a really bad product.
Yep.
And so his thesis was there's a large white space between that product and institutional grade Bloomberg, Cap IQ, Centio, AlphaSense, all these products that cost thousands of dollars a year. And so he basically felt that we should build a competitor product for the mass market. And so that's how the original idea was born. And actually my friend basically built a early stage prototype of the product with a few contract engineers, but shelved it. This is kind of mid 2018 because he basically didn't have anyone to work on it with. And when we reconnected, he actually moved back to New York, like in August of 2018.
Yep.
He suggested the idea to me, and obviously, since I'm a finance junkie, it was a pretty good fit. So it's something I started to become kind of obsessed with over the next few months, and then decided towards the end of 2018 to actually turn it into, kind of a business and just go for it, and then really build out the product, build out the team, and kind of go for it. So we basically hired a few more contract engineers in November and December of 2018 to turn the prototype into kind of towards a more finished product. And then we raised $2 million seed round in January of this year, and basically took the time period from the beginning of this year till about 5 weeks ago now, or maybe 6 weeks ago now, to turn the prototype into a live product and integrate with our data providers, and make the user experience much better. So we did that, and released the product 5 weeks ago or so now. We're almost at getting close to 30,000 users actually on the platform, which is very exciting.
That's crazy.
And kind of, I think
that's a great start.
Justifies gives us further conviction in the thesis that there's a real opportunity here to build a much better product for folks that haven't had great and powerful software platform like this before. So now we're
is there idea around monetization? Is there any sort of monetization idea like going in right now, or has that kind of like, hey, we'll just get the audience first and then it's whatever kind of makes sense at the time? Is it kind of you're going to just, or is there a whole plan?
No, so right now the product is free. I mean, my view on and I'm obviously a first time founder, so I'm not speaking with authority here, but
your partner isn't. Your partner isn't. So.
He's definitely more experienced. But I think if you talk to good founders, I think they'll also say this, and this is especially true for a continuous consumption software product where there isn't obviously physical cost of goods sold. The goal is to just build a really awesome, super engaging software product that delights users. And I think if you make it very obvious to users that you're adding a ton of value to their life and that you're making a great product that they really, that really delights them, I think monetization isn't an issue in a space where people have a lot of money and the information has real impact on their, dollars. And so our goal is, hey, let's just build a great product and make people really happy and make it really powerful. And I think if we do that over time, ultimately we're going to likely have different pricing tiers and there'll be premium features maybe we charge for at some point. But I think first and foremost, our mission is to
it's still super early. Yeah, it's still super early for you guys. You get the seed round done, and so you have some runway there. And then any ideas when you're going to go raise your next round, do you think, in another year or so?
Well, actually, we are pretty close to closing our Series A right now.
You are?
Actually.
Okay, great. Awesome. So the team is growing.
Pretty quick. We'll see. But we may be announcing something in the not too distant future. But it's exciting. We're looking to further grow the team and expand the product offering and to really just get more folks on the platform.
Great. Well, we'll put a link to it. It's atom.finance. Is that right? ATOM.
Yeah, that's right.
Finance. Yep. And then
it's Atom.
Yep.
Go ahead.
You go ahead.
Yeah, so it's the platform is you can access it at atom.finance, and you actually need an invite code to get in, so you can use the code BETA VIP, BETA VIP, one word.
Cool.
I think.
Great. And so before we end the pod, anything else you'd like to share, like any advice you would have given to your younger self, whether it's the banking restructuring group or not, going to a hedge fund, anything you'd like to share that you would have kind of told your younger self?
I think one of the things I think you learn, and this is like as you work at different places, a lot of the decisions that you think are super important or the metrics you're thinking about using to make them are often incorrect. And what I mean by that is, a lot of times you'll just be focused on brand prestige or whatever, and then what it turns out is actually you should have been focusing more on the people you're working with or what the actual job function is, or how that like impacts your lifestyle. And so I think that's definitely one thing. I think people, and it's hard when you're before you actually work somewhere, people have a framework for making career decisions, and they think they're using the right inputs to make those decisions and evaluate what is important. And generally, a lot of times those are not the actual correct inputs to be making a decision. So what I would say is a very good practice is to ask older folks who've kind of been through it and worked a lot of these places, and to kind of talk to them how you potentially you should be thinking about making that decision, because I think it could really help. If you have the wrong inputs into your decision making process, then a lot of times you'll end up with a flawed decision. So I think that's one thing. And then I think the other thing is that a lot of times the things in like that happen that seem to be negatives or seem to be like risky things in your career end up being really good things. Like when I left Blackstone, obviously I was one of the first people to leave before 2 years. Like everyone there was really unhappy at me and pissed. And, ultimately it was like the right decision. So sometimes you just have to make the decisions that you think, make sense. And a lot of times they end up being, what seems to be a potential negative ends up being a positive for your career. So
yeah, for someone so young, it was a pretty bold move, to be honest. For someone so young coming out of school, 10 months in, to say goodbye to Blackstone and go to start a hedge fund. It's pretty bold, but tip my cap to you. And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. And until next time.